Silver goes from 75, 80, 90 to the levels we've been talking about. Stopped at 66 bucks on silver. We shot back up to 90. We lived in a range. And when the war came out in early March, we had a sell-off again in silver again and gold. They both went down and they knocked out that low. They broke the low, ran all the sell stops, goodbye, and immediately reversed and shot back up into the range like, ha ha, fooled you, okay? It was a bear trap. And I think that was the low, the March 23rd low at 61. And I think now you probably got support right around where you are in the mid 70s. And all you got to do now is inch back up again toward those highs. The high we saw this week, 90 bucks. And you're out of here. It's cheap versus silver. It's cheap versus gold. Plot the spread chart. S&P versus gold, oil. It's off the page. It's like it's a free asset almost when you look at the spread charts. So I think it's a place to be, but wait for a shakeout. It's just be a pullback in an uptrend. But it's the kind of thing that one should expect because you sucked in a lot of headline guys.
And down at 80 bucks, you buy it. Where do you see it going?
Well, the one I'm most focused on is silver because I think silver could go absolutely parabolic.
And the crisis you're talking about is you're talking about the federal debt, $40 trillion worth. And at some point, this is going to catch up to us.
And it shake enough other assets that people have been comfortable with because the Fed's been printing the money and making money free for 10 to 15 years. You know, you look at a Fed funds chart, go back 75 years, you can get it from St. Louis Fed, and you've either been at zero or you got up to all of 5% or so, and then back down to zero, and then back up to 5. But if you look at that 15, 16-year history since 2009 and compare it to the other 75 years, it's a joke. It's like off the page cheap. Money has been made artificially cheap for a decade and a half plus, and therefore the liquidity flow went somewhere. It happened to go into stocks. But as soon as the investment public and asset managers realized, uh-oh, it's not working anymore for stocks, it's working over there in the price of commodities or the price of gold and silver. I'm going to shift my money over there. And so when the stock market wobbles, that will be a further fuel, one for the Fed because it'll create some data points for them, but for fuel of money moving that the Fed prints into the monetary metals where it's protected. And I think that's why you got to watch the bonds because they could impact the stocks. If they impact the stocks like we think, by this summer you'll realize, oh yes, the money's flowing from stock to gold and monetary metals.
The Fed spent 15 years making money nearly free, and now investors are about to discover the bill was never cancelled, only delayed. Michael Oliver notes that liquidity didn't disappear after 2009, it simply inflated financial assets while masking structural debt decay beneath the surface. The real danger is not a stock correction itself, but the moment institutions quietly decide bonds and equities no longer preserve purchasing power. That shift punishes savers first because retail usually reacts after capital rotation is already underway. Next, Michael Oliver reveals why bond market instability may become the hidden accelerant behind silver's next explosive move.
And I always think it's a good idea to quantify when you talk about money printing, just to throw out some numbers so we can put it into perspective. But in January of 2020, the money supply as measured by M2 was at 15.4 trillion. Now it's over 22 trillion. So that's an increase of well over 40%. And they just keep printing money. And that's what's happening here. So you mentioned you're very bullish on silver, more so than gold.
Yeah.
And the last time we spoke, it's also up 3 to 4% of the year. It's been very choppy. Just this week alone, it got as high as 90 bucks. And the last time I looked, it was at 75 bucks. So it's come under pressure here in the last day or two. But the last time we spoke, early February, you said your target on silver was 300 to 500 bucks by sometime in the summer.
Yep.
The reason was you said it had to do with a number of fundamental and technical reasons that
A whole
would
bunch.
create a reacceleration in this price movement. So maybe you can just speak to that and where you think silver's going.
Yeah. Before you mentioned year to date in the stock market and gold, for example, but if you go back a year to date, May 15th last year, silver, I just did the math before we came on, 137% up. Silver. Gold, 40% up. S&P, 25.6% up. So monetary metals year to date, May 15th to May 15th, is up a lot more than the stock market. So lately, yeah, the stock market's had this goose. That's fine. We love it because we don't want the market to top with negative news.
M2 expanded by more than 40% in barely 4 years. Yet policymakers still act surprised that hard assets refuse to stay suppressed. According to Michael Oliver, silver outperforming both gold and the S&P is not speculative mania. It's delayed monetary repricing, finally leaking into public markets. Wall Street keeps celebrating stock resilience while quietly ignoring the purchasing power destruction underneath nominal gains. For retirees and long-term savers, that distinction matters because rising portfolios mean little if currency dilution outpaces them in real terms. Next, Michael Oliver exposes why institutional money may already be positioning for a commodity-led reset behind the scenes.
Want it to be in a happy phase and then top. Your question was again silver.
What's yeah.
Silver. I'll give the story again about copper. Just one example of many. They're rare, but they do occur. Copper was stuck in a price range for multiple decades, between 50 cents and $1.50. 1970s, 1980s, 2000, 2005. In late 2005, copper decided to move up out of this old reality, 50 cents to $1.50. And when it crossed through $1.50 in late 2005, within several quarters, it was $4.10. Wow. No headlines. It was peculiar to copper. It didn't happen in all the other base metals. It wasn't because gold was exploding at that same time. It was copper went berserk. And then, yeah, it had sharp sell-off after that peak, but it lived in a new range around 350 for decades, a couple decades since 2005 to 2020 something. And 3 to 4 times the price of its prior average multi-decade price. But when it did it, the point is it did it in an emotional burst. Lead did the same thing in 2007. It had a similar chart type situation. Exciting metal, lead, okay? Silver had the same pattern for 50 years. Gold kept taking out every high. 1980, taken out in 2011, took it out again. But silver still capped at 50 through late last year. What's going on there? I mean, it's a monetary metal. Copper already blew out its multi-decade highs. Lead did. Gold did. Why is silver contained in a box?
Markets usually break out quietly before the public invents a headline to explain them afterward. What Michael Oliver is highlighting is that copper's 2005 surge happened long before mainstream investors understood the inflationary regime change underway beneath the economy. Silver sitting capped for decades while nearly every major hard asset repriced higher created a historical imbalance that institutions likely noticed years ago. Retail investors focusing only on daily volatility risk missing the far larger structural shift developing underneath long-term commodity charts. Next, Michael Oliver unravels why silver's decades-long suppression pattern may itself be the setup for an emotional upside panic.
Well, it decided no more. Now, let's forget the reasons. Maybe it's manipulated. We know there's been a lot of that, institutional manipulation. But the market said no more. I'm out of here. And usually when markets get overpriced at a high, they go down more than they should to correct. And when they're underpriced at a low for too long, when they correct to the upside, they quite often will go maybe twice as far as they reasonably should in an emotional burst, like copper did. We measure silver on a logarithmic scale instead of an arithmetic normal dollar price chart where, already it's more than doubled. From $4 to 50, you add $45 on top of 50 and end up with 95. So when it got to 95 late last year, that doubled the dimension of that range. But when you go to a logarithmic scale, which is the best way to do it, copper, for example, back then, when it went from $1.50 to 410, went up to a ratio scale dimension beyond the prior reality. Silver, if you do the same thing, you had a range from $4 to 50 repeatedly. Well, that's like a tenfold dimension, $4 to 50, right? A little more. What's tenfold above 50? 500. And when you do a monetary assessment, what's the money supply versus where it was in 1980? What's the money supply now versus 1980 2001? silver would be up in that range, 3 to 500, just to catch up to the money degradation. Also, for silver to catch up to its relative value to gold that it's seen over the last half century.
Central banks insist inflation is stabilizing, yet the long-term purchasing power math tells a radically different story. Michael Oliver's argument suggests silver's breakout is less about speculation and more about decades of accumulated monetary distortion finally repricing in one violent phase. The mainstream narrative treats metals as emotional trades, but ignores how aggressively fiat supply expanded while silver stayed historically compressed relative to gold. For wealth preservation investors, the risk is not volatility itself. It's underestimating how fast neglected assets can revalue once institutional psychology flips. Next, Michael Oliver reveals why logarithmic price behavior may expose how understated silver's upside actually is.
Like 1980, it was 6.5% the price of gold. 2011, it was 3.1. Well, right now you're still below 2. So it's still cheap. It's broken out. That spread is broken out, favoring silver, and that's why silver's done better over the last 12 months by far than gold. Like I said, up 130-something%, gold's up 40-something, okay? The next phase should get silver, I think, in a tantrum mood and level, probably within 3 or 4 months. The issue is to break up out of this consolidation. It's violent consolidation zone. I think we're in the process of that right now, despite today's pullback.
Right. So we're going to go through a period of consolidation, a lot of chop back and forth.
And then we're about to emerge. Yeah.
Right. And so do you still have the $300 to $500 target by sometime in the summer, maybe late summer?
Yeah. I still think it's quite reasonable. I can come up with it so many different ways. And this pullback that we had measured by our momentum trend metrics, well, it spooked a lot of price people. In no manner did it jeopardize the long-term momentum trend that we measure using quarterly momentum or annual momentum of silver and gold. Weren't even threatened, okay? Especially annual momentum. Whereas at the 2011 gold top, for example, a mere $100 or so off that high, annual momentum blew structure. This time, it didn't break any structure in the drop. The only break you had in gold and silver were intermediate metrics, meaning metrics that when they break, they're worth a couple months of downside or wasted time, which is a stumble.
Markets rallied hard this year, but silver quietly outperformed nearly every major traditional asset class, while most financial media barely noticed. This is where Michael Oliver's thesis shifts from simple bullishness into structural momentum analysis, driven by long-duration trend behavior, not short-term headlines. Temporary pullbacks are scaring retail traders precisely because they're conditioned to think volatility means weakness instead of transition. For older investors protecting retirement capital, confusing consolidation with collapse can become an expensive psychological mistake during commodity repricing cycles. Next, Michael Oliver exposes why momentum structures today look fundamentally different from the breakdown conditions seen at the 2011 gold peak.
It's not a major trend change. And those have now dissipated. And silver is now leading gold up out of the hole recently, and percent-wise from the March low, for example. And I think that silver is now leading us up out of here. And I suspect this pullback you're seeing right now is about to end either today or Monday, and you'll go back up again. The price guys will start to wake up. They don't look at momentum. They don't know about that. They don't know how to use momentum the way we do. But when they look at a price chart, you've had 4 rallies, I think it is now, including the recent one, up to $90. They sell it there. They sell it there. They sell it there. They sell it there. You don't make a top that way. You don't keep coming back to the same distribution. I mean, that's persistence is what that says. And particularly what silver did in March was really bullish because it took out the February price low. If you recall, that sharp break in January, February stopped at $66 on silver. We shot back up to 90. We lived in a range. And when the war came out in early March, we had a sell-off began in silver again and gold. They both went down and they knocked out that low, the Feb low at 66 on silver, went to 61 for about 2 hours. That's how fast it was. They broke the low, ran all the sell stops, goodbye, and immediately reversed and shot back up into the range like, ha ha, fooled you. Okay. It was a bear trap.
Silver briefly collapsed below its February low for barely 2 hours before violently reversing higher, and that kind of move rarely traps institutions. It traps retail emotion. As Michael Oliver points out here, repeated rallies back toward the same resistance zone often signal accumulation underneath the surface, rather than exhaustion at the top. The mainstream narrative focused on war headlines, while momentum traders quietly watched failed breakdowns and aggressive recovery behavior. Investors protecting wealth should pay attention when markets refuse to stay weak despite maximum fear, because that usually signals stronger hands taking control. Next, Michael Oliver exposes why repeated tests near silver's highs may actually indicate pressure building for a breakout, not a ceiling forming.
And I think that was the low, the March 23rd low at 61. And I think now you probably got support right around where you are in the mid 70s. And all you got to do now is inch back up again toward those highs, the high we saw this week, $90. And you're out of here. That's when I think you see that acceleration phase.
Okay. Now you mentioned copper a couple of times, and copper's done very well this year. It's up over 10% on the year.
Mm-hmm.
It has come under pressure here in the last couple of days, but nonetheless, what's your take on copper?
It's long-term bullish. Nothing it's done recently with a pullback that got down to the lower 5 area jeopardized anything. It was just a price pullback. Momentum said, nah, no problem. And now you've been up, made new highs again. You're well over 6 again. Uh, I don't have a target on it, except to say that we think $7 or $8 would not be surprising whatsoever. I don't think you have a parabolic situation like you have in silver. I mean, if silver goes from 75, 80, 90 to the levels we've been talking about, it would be, copper would be, off the page. I think it's the silver situation now is the prime focus. Yes, the base metals are going up as the whole complex, commodity complex, is going to go up because it'll be the prime recipient now. I don't care if the economy's weak. That doesn't stop Dr. Copper. That's a myth about copper. It can go up in a bad economy. There are plenty of major examples of copper bulls during recessions.
Copper is climbing even while recession fears keep dominating headlines, and historically that divergence has exposed major shifts before the public catches on. Michael Oliver notes that commodity momentum does not always wait for economic optimism, because monetary debasement can overpower weak growth conditions entirely. Wall Street still treats copper as a pure industrial signal, but global liquidity cycles often matter far more than manufacturing demand alone. For long-term investors, ignoring commodities during recession narratives can mean missing the early stages of inflationary repricing across the entire hard asset complex. Next, Michael Oliver unravels why silver may separate violently from other metals once institutional momentum fully accelerates.
But they're going to go up strongly, but I don't have a target on copper that I could come up with in any solid view. $7 or $8 looks totally reasonable, but it could go well beyond that.
Okay, and oil, it's trading around $100 a barrel. I'm talking about WTI. You said it's cheap at $100.
Yeah.
Where do you see oil going?
Well, it was a laggard to the Bloomberg this time. Last time, back in 2021 to 2022, we had the commodity explosion then. Oil was a leader. No headlines. In fact, when the war began in Ukraine, Russia, oil peaked. Okay. Think about war. Oil goes up. No, oil went down then. It went from $130 down under 100. Okay. No, down into the 60s, excuse me. In February this year, October last year, the Bloomberg, we had a buy, so it was 106.50. Right now it's 142. Okay. 106.50 last October. Oil didn't join technically into the upturn until January this year. Price was 65. WTI closed that month at 65. That's when we turned long-term bullish on oil before the war began. Unfortunately, when the war began, you sucked in a lot of headline chasers. And when you get headline chasers, they usually get reamed for buying high. They chased the news. They probably bought it $100 a barrel. They got up to 117 a couple times. Right now we're above 100 still. When the Iran situation abates in any way, doesn't have to go away totally, but abates, don't be surprised if oil drops back down in the 80s or something.
Oil peaked when the war headlines became loudest, which completely contradicts the simplistic narrative most investors were fed. According to Michael Oliver, the real breakout in oil happened months earlier, near $65, long before geopolitical panic pulled retail traders into emotional buying. Media coverage tends to confuse catalysts with causes, because institutions often position before public attention arrives. That matters for ordinary investors because chasing headlines usually means buying after smart money already captured the easier move. Next, Michael Oliver reveals why a sharp oil pullback could actually confirm the long-term commodity bull market instead of invalidating it completely.
And it's at that point, and only then, would I be interested in including oil and oil-related stocks in a broad commodity portfolio. It got too far ahead of itself based on headlines, and therefore there's some vulnerability there to flush those guys who bought high. And you could get a pullback. But oil is in a major bull trend. It's not just the war. The war happened after the breakout. So people like say, oh, it's just because of the war. No, it's not. It broke out in January at 65. And I think the reason is, if you just go back and look at oil price history, $65, been 140 and 130. How come stocks are printed at the new highs, but oil's half the price it was in the past 15 years? And even then, to compensate for the degradation in the money unit, copper will probably be 200-300. Okay, it's cheap versus silver. It's cheap versus gold. Plot the spread chart. S&P versus gold, oil. It's off the page. It's like it's a free asset almost when you look at the spread charts. So I think it's a place to be, but wait for a shakeout.
I'm sorry, when you say wait for a shakeout, like, so where does it go from 100 down to where?
I could see support in the, well down in the 80s if you want to go that far, maybe even the high 70s. Because again, we're bullish at 65. And a pullback like that does not in any way jeopardize the trend structures on momentum that broke out in January at 65.
Stocks sit near record highs while oil still trades far below prior cycle peaks. And that imbalance should make macro investors uncomfortable. What Michael Oliver is highlighting is that commodities may still be historically undervalued relative to inflated financial assets distorted by years of central bank liquidity. The public keeps interpreting every oil spike as temporary geopolitics, while institutions appear to be analyzing long-term purchasing power deterioration instead. For retirement-focused investors, the danger is assuming traditional portfolios remain diversified when monetary conditions increasingly favor hard assets over paper assets. Next, Michael Oliver exposes the hidden spread relationship, suggesting commodities remain dramatically under-owned by institutional capital.
It'd just be a pullback in an uptrend, but it's the kind of thing that one should expect because you sucked in a lot of headline guys.
And down at $80, you buy it. Where do you see it going?
Well, once we get a correction that we think is good and we see factors that indicate upturn, we'll tell our subscribers. I don't know where oil's going because in the next several years, commodities are going a lot higher. And they're going to be a beneficiary of monetary expansion, which they've not been for decades now.
Commodity pullbacks scare late buyers out of positions precisely when longer-term monetary trends remain intact underneath the surface. Michael Oliver's argument suggests the bigger story is not short-term oil volatility, but the return of commodities as beneficiaries of sustained currency expansion after decades of financial asset favoritism. Central banks publicly claim inflation is under control, while fiscal systems still depend on continuous liquidity creation to function. For savers relying solely on conventional portfolios, that contradiction creates a slow erosion of purchasing power few advisors openly discuss.